Hey there, everyone. Ryan Schul here. Welcome to my data science machine learning channel. So in the project today, I want to talk about how we can test hedging strategies and use historical stock prices to test a couple ideas that we have. Okay, so we want to do some validation of our ideas, right? To see how lucrative potentially these trading strategies can be, or maybe they're not lucrative at all, right? That's what we have to test for. So why would we even do that? There's a whole plethora of reasons. Basically, risk management, capital protection, realistic performance evaluation, identifying market regimes and hedging, which types of hedging strategies work the best, quantifying costs of hedging, validating hedging instruments, stress testing portfolios, right? Understand strategy designs, compliance and risk reporting, as well as optimizing portfolio efficiency. These are risk-adjusted returns, okay? And then if you get into portfolio optimization, or if you have a curiosity about that, I have several videos on my channel that cater specifically to that topic. So I'm going to go ahead and import some historical stock prices right here, and then calculate the returns on all the prices. I love how Python is so elegant. You just have one line of code right here that helps you to calculate all the returns, right? So here comes the import. We have all the prices going into a pandas data frame, and then we just have prices dot percent change, dropping anything that's NA, and just one line of code. We have all of our returns, okay? So in this case, we're going back in time 3 years, so it's 36 months. The start is 36 months ago. The end is today, right? So we're going back 36 months in time. So we have the return. That's very nice. Now we're going to look at momentum. Top MOM, I'm just abbreviating momentum here, and bottom momentum. And we're going to print the list, okay? So basically, we're getting this 5 largest momentum moving stocks, and then the 5 smallest momentum moving stocks. We're going to say this is the top, this is the bottom. I'm going to print each. So the highest momentum stocks is Microsoft, and the smallest momentum stocks is UNH. Marks right there. It's what's highlighted, right? So just with a couple lines of code, we can get the long strategy and the short strategy based on momentum. So I think that's pretty cool. Let's go back and let's go down here and look at another. So this is an example of volatility hedging. So again, we're looking at the returns rolling 63 periods. Okay, going back in time, just 63 days back in time. And we're looking again at the N smallest and N largest. So the lowest volatility is N smallest, the largest is N largest. And then we can print the results right there. So if the strategy is going to be based on volatility, this is low, we go long, and it's just short volatility. So we go high, right? We want the portfolio to be a little bit more conservative. We're looking for a low volatility strategy. So we're going long these stocks and shorting the stocks that have a lot of volatility. Now, you can make the argument maybe you want to trade on vol. If that's your thing, that's okay. I think for most people, they don't want a lot of vol. They want something that's predictable and repeatable. So usually you go long the smaller volatility and short the higher volatility, okay? So let's look at another strategy over here, again, going back 63 days. And we are going to take the N largest and then the N smallest. Again, positive. Over here is going to be the largest, and the smallest is going to have a negative skew. And anything that's positive skew, we go long. Anything negative skew, we go short. And again, very quick, very simple, very elegant way of doing our coding right here. This shows us the pos, this is a negative, and then we can print out all the stocks associated with these particular trading strategies, okay? So it's still running, I guess. Though I thought it'd be a little bit faster. Okay, we'll give it a second. I can take a water break. Okay, and again, skew can indicate the tail risk, and you can hedge by going long positive skew and short negative skew, right? So long positive skew has a long tail to the right, negative skew is a long tail to the left, right? When you have normal distribution, all the stocks are kind of fall into a bell-shaped curves, more or less. But if you have a big skew to the right, you're going to have a long right tail, and big skew to the left, you're going to have a long tail to the left. Okay, so here's the positive skew. We go long these stocks and then short the negative skew. Okay, so I think we're in a good spot. We're doing good. Let's look at mean reversion and rebounding hedging. Okay, so I'll hit Control Enter to run it. we can go long the worst performers over the last month, expecting a rebound. Okay, so if a stock was down considerably, maybe 20, 25, 30%, give or take, you would expect that potentially to bounce back. Now, of course, there's no guarantee of that whatsoever. But if you have a mean reversion strategy and you expect that stock to bounce back after 4 weeks or 5 weeks or 6 weeks of being down, these are the stocks that you would go long. Okay, and these are the stocks that you should short. Okay, and again, shorting is selling, and long is buying. Okay, so another strategy here is composition tip. You can even combine different strategies, so we can look at the volatility and the momentum and get a composite score, and then take the 5 largest and the 5 smallest. So the volatility comes from where? From over here. If I could do Control F, so there's the volatility, and the momentum, Control F, and the momentum was probably the first one we did, yeah. So now we're combining volatility plus momentum, okay, getting a composite score, and then again taking the top 5 and the bottom 5. So the 5 largest would be hedge longs, and the 5 smallest would be hedge shorts, okay. So these we would buy, these stocks we would buy, and these we would sell, okay. Or go short in the position, expecting the stock price to go down, and then when it depreciates, you buy it back, and you buy it at a cheaper price, and you put that back to the broker at the original high price where you originally sold it. So you sell high, buy low, but you are, you sell high, buy low, which would be the opposite of a long, where you buy low and sell high, ideally, right? It doesn't always work out like that, but that's the name of the game. Okay, so here we get the latest price today, and look at the price from 1 month ago. So we have the latest prices right here. 1 month returns is the latest minus prior prices going back 21 days. Okay, so there's about 21 days in a trading month. Remember, we subtract out every Saturday, every Sunday, and every once in a while there's going to be holiday in these months, so we have to subtract that out too. Okay, so 21 days back is 1 month. These are the long stocks. Okay, so these are the stocks that we're interested in buying, and these stocks are not performing very well relative to the price today given price 1 month ago. That's a strategy we're looking at now, and these stock prices are not doing too well for these guys right here that are highlighted. So we can create a strategy of portfolios. Each strategy defines 2 groups. The long portfolio is expected to outperform the short portfolio, right? So we have an equal weighted average return of long and short portfolios. Let me run this, Control Enter. Okay, and I think we're fine there. Wait, let me just see. Let me display this thing here. Oh, that's why I commented out. Okay, I don't need to see the whole thing. I know what it's doing. So we just have all the strategy returns there. So I'm going to go ahead and pull in some historical data for the S&P 500. And this is S&P 500. We're going back 1 day. Wait a second. Does that make sense? Start. Oh, no. We're going back 36 months. Yep. This is daily data. And the start is going to be the current time back. The end is the start plus the days of data backwards in time. So 36 times 12 times 36 is what, 750-ish. Okay, so we're going back about 750 days. I can tell you right now. So print. $753. Okay, and these are the columns over here. So we have open, close, low, high volume, and then the benchmark return, which is what we're calculating. Okay, so that is the percentage change from the prior day. So let us go ahead and create a couple new strategies now. So we have the original strategy return mean times 252 days in a year. Strategy returns standard deviation times the square root of 252. That's to get the annualized volatility. And then you have the mean returns or annualized returns divided by the annualized volatility. We always annualize these things to get everything in the same relative time frame, right? So if you make 10%, what does that mean? Is it 10% in 1 day, in 1 month, in 1 year, in 10 years? Because it's a big difference, 10% in 10 years versus 10% in 1 month, right? So to annualize everything is just one standardized way to get everything in the same uniform sort of time measurement, okay? So that was the strategy. This is the benchmark return. I think I just hit Control Enter. Let me do it again just to make sure. And you can see the strategy returns 8.62. The benchmark is 18.4. Strategy 11.5. Benchmark 17. Strategy here, Sharpe ratio. Remember, this is a risk-adjusted return. So the average return minus the risk-free rate divided by the standard deviation. Higher is better. Usually 1.0, you're doing okay. You're beating the market. If it's under 1.0, it's not really performing too well relative to the risk that you are underwriting, okay? And the maximum drawdown is negative 12.68. Benchmark is negative 18. So this is interesting that the portfolio is really underperforming on these three metrics, but it's actually outperforming on this maximum drawdown because the maximum loss from the high point to the portfolio to the current point is only 12% loss, right? And for the benchmark, it's actually 18%. So Sharpe greater than 1, decent risk-adjusted return. Consistent upward slope cumulative returns is the persistent edge, right? And law of drawdowns, better capital preservation. So lower drawdown, the better off you're going to be. Let's look at a plot of the same thing over here. Okay, so we have the combined portfolio over here, Control F. This is our combined portfolio. X axis is going to be the index, and the Y is going to be the strategy that we're using. This is just going to be a basic line chart, and I'm going to use blue for the strategy and red for the benchmark here. And we can go ahead and dump all of that into this scatter plot, and we can see how it looks. So in this case, the strategy really does underperform the benchmark S&P 500. So we actually did a lot of work, and we did not generate a whole lot of decent profits for all the work that we did. So, like, what's really going on there? How do we interpret this, right? Long-short hedging strategy is working, but just buy and hold simple strategy, investing in the S&P 500 is actually working quite a bit better. So that's something that we should be considering. We have reduced drawdown and lower volatility, which is good. But I think what's happening here is our strategy is working, but just dumping everything into the market and leaving it alone actually works quite a bit better because we have lower drawdowns, so we're protecting ourselves on the downside. You can see that the negative maximum negative return is less for the strategy than for the S&P 500. But I think because we only have about 30 stocks in this portfolio, S&P 500 has 500, we're missing out on a lot of upside potential that we're getting from exposure to the S&P, but we're not getting from our own portfolio, okay? So this significantly underperforms on return and Sharpe ratio. We saw that. This means we're giving up way too much upside potential, but the hedges are working on the downside, right? So we're protected on the downside, but we're missing a lot of this upside potential. So by contrast, the benchmark has higher returns. We know that higher Sharpe ratio. We know that slightly more risk, but better risk-adjusted return. The market conditions favor passive investing. I put together a few videos a couple of months ago, probably 3 months ago, and compared 5 different strategies to just investing in the S&P 500. All 5 times the S&P 500 outperformed every single strategy that I put together. So really, when people say buy and hold and just leave it alone, a lot of times that does work. I'm going to put out another video a little bit later today where the strategy that I picked does outperform the S&P 500. So I'll showcase that in just a bit. But you can never predict in advance like which one is going to do better. Is it a buy and hold strategy? Is it active asset management strategy, right? When you look back in time, it becomes very apparent. It's very obvious where you should have been with your money. But going forward, it's not that way, right? You have no visibility here. You don't know which is going to pay off more. Maybe going forward, starting tomorrow, well, tomorrow's a Sunday, we really wouldn't be trading in the market on a Sunday, but starting Monday, maybe the buy and hold strategy will continue to outperform these strategies that we put together earlier. Maybe it's going to flip, right? Maybe the buy and hold is not going to do so well, and maybe the active investment strategy is going to pay off. You can see that the line is up pretty huge over here, right? So it's really starting to bounce back. Is that going to continue? Nobody knows, right? That's anybody's guess. But in conclusion, over the past 3 years, this is the way it worked out. Buy and hold really outperformed the active management style. And this makes passive S&P 500 investing hard to beat unless you're really concentrated in those winning stocks, right? Like we only had 30 stocks in the portfolio here. We missed a lot of upside potential because the S&P 500 has 500 stocks. We don't have exposure to most of those, right? Our exposure is the Dow 30. So that's it, guys. Just want to show you how that works. I'm going to wrap it up here. Thanks for your time today. I appreciate you sticking through to the end. I am going to shut off my recorder, and I will share this video with you guys a little bit later today. I'll talk to you soon. Bye for now.